GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com.
Hey, thanks for having me. It's great to talk with you. It's an interesting week so far.
Mike, can you tell our listeners a little bit about Wall Street Window?
Oh, sure. Thanks for asking. Obviously, the website's WallStreetWindow.com. It's a blog, basically, that I run. I do a post almost every single day about what I think is the most interesting stuff in the stock market. And if you sign up to the free email list, I also send out the most interesting stories I'm reading for that day, too. And then there's also a premium pay members area, more specific stock picks or trading ideas. But that's the general gist of it.
Mike, the stock market, it seems to me this summer is very frothy. I mean, it seems to build up a lot of volume, but there's not a lot of substance to that volume.
Well, we're actually at a really interesting moment with the stock market. First of all, I must admit I've been a skeptic of the rally that we've had since February, and the reason why is because a year ago, really in July of 2015, I thought I was seeing signs that we were making a major top in the stock market that would lead to a bear market. And, of course, we dumped in that August and dumped in January. But both times the market came back. But despite that, it really hasn't gone anywhere for people. So, in a sense, the people that are super bullish have been wrong, and the bearish people have been wrong to a certain sense, too, because the market hasn't been in a bear market yet in the sense of making new lows and having a rally then making new lows, but it also isn't going anywhere. Now, this August, the S&P 500 did finally make a new high, and it was the first new high made in 3 years. So people were waiting for 3 years to make basically 11% from where it was back then, 36 months ago. That's, kind of sucks. Those aren't the kind of returns people want to make over 3 years. And then this year, of course, we've also had wonderful things happening in the gold market. Gold stocks went up over 200% from the lows of January. The price of gold went from below $1,200 to knocking on $1,400 an ounce. So that's a new bull market that started this year. So there's always ways to make money in something, and that's where the gains, that has been the best place to make gains for much of this year. With the stock market, though, this month in particular, I think could be a pivotal point, just like last July was last year. And the reason why is we've broken out, but it looks to me like a completely fake breakout. The market hasn't been able to do much of anything all month. The volumes actually vanished the past couple of weeks. There's a day 2 weeks ago where with the NASDAQ, it was the lightest day of volume since the half a day of trading before last Thanksgiving. And if this breakout was going to be the start of an epic move, as so many people have been hoping, we would be seeing the market go up as we're speaking to, beyond new highs. We'd be seeing the volume kick in and new leadership emerging in sectors in the market. None of this stuff's happening. In fact, a lot of the listeners are people who have a lot of experience in the gold markets. And to me, the stock market is very similar to the way gold stocks are trading in 2012, because back then they had gone up substantially for 3 years, but they stopped going anywhere. They'd break out to a new high and then just come back down, and then fall of that year they tipped into a bear market, and there's a very vicious drop for the mining stocks, and it started in October 2012. So I think that's basically the type of action the stock market's doing. What I'm looking for, though, is we have a support level in the S&P 500 around 2060. That's been support now for about a month, and if we break that level, close below it, I think we're going to start to see the market begin a move down to at least the lows of January, most likely through them. So even if the bullish scenario is we hold the lows, but even from there, that would be a sizable drop for people who are buying right now. And that's the funny thing about markets is really the only way to make money is if you buy after something's dropped. You get in at a low price, and then you're able to ride it back up. Unless you're in this epic bull market, like you saw in the 90s, which isn't the case. So the problem is most people, they buy something, they get fully invested, and then stuff starts to drop on them, and they just hold until they lose so much money they can't take it anymore. Then they sell. When what people need to be doing is selling when things have gone up a lot and the valuations are really high. And that's really where we are with the stock market. The cyclically adjusted PE is, only been as high as it is now, about 3 times in the past 100 years. There's no real sector leadership that's breaking out or doing anything. So I think, people should be using this time to get out of a lot of positions that they don't like or whatever, raise some sort of cash reserves. I know no one listening is going to sell everything. Maybe they shouldn't sell everything, but I think if people have some cash on hand, 10%, 20%, whatever, then they'll be in a position to be able to buy whenever there is another dip. And the only way you can be in a position to buy when there's a dip is to sell in a rally. It's impossible to time the top of a rally. It just is. So you just have to be thankful that if you're sitting on big gains or whatever, to be able to use them and sell so you can be in a position to buy later. And the same thing goes, with the gold stocks. What I do is I hold a core position in gold stocks because I think they're in a brand new bull market that started this year. Most bull markets last for several years. However, if I were to put 100% of my money in them, what would happen to me is if they fell 20% and they've already fallen 15% this month from their high, I would probably get scared and sell out. I don't want to lose half my money or something. So to prevent myself from doing that, I try to hold a core position of 10%, 20%, whatever is right for people, but somewhere below 30%, let's say. I don't have 30% of my money as a core position, but, people need to think about that level for themselves. And let's say you had 20% of your money in it, and the gold stocks fell 20%. Well, that's only a 4% loss. It's not a really big deal for people to manage. So what I've been telling people to do the past couple of weeks is we've had a huge rally in the mining stocks this year, and not to be afraid to take some money off the table in case, you bought in early and it's doubled on you and so forth, because I'd rather someone do that now than if it dips more. And this, every time this year we've seen several pauses in the gold stocks, and I've seen lots of people, every time it happens, call for a crash or something, because we all have the memory of the last bear market that was so terrible from 2012 to last year, the gold stocks fell just about 90%. Every rally turned into a disaster. So that's still in people's memory. And therefore, every time we have seen a pullback, people say, oh, this rally isn't real, it's going to crash, and so forth. And I've consistently, so far this year, been saying, don't ignore those people, just this is a real bull market. However, at this point, I do have to say, I think this finally is a real correction so far, unlike any that we've seen up to this point this year. And that doesn't mean gold's going to fall to 1,100 or 1,000. I think we might go to 1,250 or possibly 1,225, which isn't really a big deal at all. And the gold stocks have probably already dropped a half or three-fourths of whatever they're going to fall at. But to me, the most important thing is that you get these periods where you can pause in a bull market, and I think that's what we're seeing now, which they end up being great buying opportunities for people who take advantage of them.
Mike, I know you're a big fan of diversification. Do we concentrate too much on the North American markets and don't look enough at other markets?
Yes, we definitely do. In the United States, I went a few weeks ago to a relative of mine passed away, and I was with some people that went they had to go to a stockbroker and get the money transferred to them, and I went along because I wanted to see what the people would be told by the stockbroker, and they were invested in municipal bonds that they had bought years ago, paying 5% interest, which is fantastic. You know, on the way up there, I said, don't let these people talk you into selling those bonds, because you can't get 5% interest in anything now. You know, these things, it's like a golden ticket that you're getting. But we went there and they gave us their spiel, and basically they were telling people, put half your money in the United States stock market and half your money in the United States Treasury bonds. And they said that buying gold is as risky as buying the most speculative penny stocks, and foreign markets are just as risky too. And this type of thinking is prevalent all in the United States. I think in Canada it's probably similar, where I'm sure you're not told Canada's bad, but you're probably told to stick to North America, maybe a little bit more of an open mind toward the commodity markets. But that's really the big problem, I think, that most people face in the future in the United States, is that that's how everyone's invested. And really, so far in all our lifetimes, that has been a good way to invest, as long as you rebalance your portfolio, which this person was advocating to us to do once a year, I think was his idea, which that would be fantastic. If, someone, let's say 1980, did that, they rebalanced their portfolio every year, so they're 50-50 bonds, 50-50 stocks. What that would do is, when those terrible bear markets happen, let's say in 2008 or in the year 2000, the bonds went up. So you would have been able to make money on the value of your bonds while the stock market fell. The problem is, few people will do that. They won't necessarily rebalance their portfolio. If the stock market goes up, they get so excited that they start thinking they don't have to do that anymore. But that's the basic tactic of diversification. It's all someone has to do. Take a look and make sure they're proportioned correctly, because things will, one thing will move up, one thing will move down. Now, the danger, though, that we face now is, I saw a great quote the other day by Jim Rogers, and he said that if you went to the year 1900 and then sped ahead to 1915, you wouldn't believe what you've seen. In 1900, everyone thought there's peace and prosperity, free trade. In 1915, all hell broke loose. Millions of people died over the next couple of years. Think about 1950, though. If you go to 1950, and if you were able to jump in a time machine to 1965, who would have believed we would have been in the Vietnam War and trapped endlessly there? And the sexual revolution in the United States, the hippie movement, the civil rights movement. You would have never dreamt of any of these things in 1950. Well, in 1980, who would have dreamt that the Berlin Wall would fall 19 years later? And in 1990, or the year 2000, in 1990, who would have dreamt that 9/11 would have happened? And then here we are, almost 15 years later, and we're still in Afghanistan. Who would have thought we'd be there for 15 years? And, and the point is that things change in ways no one can imagine, and that one day, and I think it's going to be the future bear cycle up ahead of us, the bond market is going to go down at the same time the stock market goes down, and that will be the most devastating situation for American investors to face because they're totally unprepared for it. And the only way to prepare for it is to diversify in gold, in silver, in commodities, and even in other markets overseas, which I own gold, I own mining stocks. I'm not myself personally right now invested in markets overseas, but I'm watching them very closely because I think the next time we get a stock market drop, which I think is coming ahead of us, I'm likely to start to move money into these foreign markets. I'm looking at the Russian market as a possibility, the Greek stock market even, if it can show signs that it's going to turn around, even some places in Asia. I'm not really interested in China, but I'm eyeing Vietnam very closely. So, but I'm waiting because I want to see how these markets will respond during a stock market dip in the United States. Because right now, the U.S. stock market is, at this moment, the strongest stock market in the world. And if it dips, it will take a lot of stuff down with it for a short period of time. But the thing about a drop in the United States stock market, it provides a wonderful opportunity to invest because you can see what's holding up against it at some point and start moving money into those places. So that's really my long-term game plan as far as investing in, all over the world. I believe gold should be a core position for people, but, I'm not putting 100% of my money in gold. I got right now, as we're speaking, 20% in it. So, I'm not going beyond those levels for anything myself.
Is it a common mistake for people to put most of their money into things they like?
Oh, it's the number one mistake people make, and I can say it's a mistake because I've done it in the past, and that's what's always, if there's one thing that's caused me to make mistakes or cause problems in the markets, it's that one thing, and because I've admitted to myself that I've made that mistake, it's easy for me to see that that's actually that's when other people make mistakes, that's actually the main cause of it all. Because if you get 100% invested in something, it's almost impossible to divorce your emotions from it and be objective on it. And I had made a mistaken thought or a belief that I think people run into, that being 100% invested in something in a bull market is the best way to make money, to get rich or something. And that's actually, I found, isn't actually the case, and it's not necessary either, because if you diversify, you can buy into things that are all not trading together and be in bull markets. So all of them can be in bull markets, and they don't all have to be trading, exactly in sync together. So, and you also have there's a mathematical bonus to doing this rebalancing too that helps boost returns and lower losses when they do happen. So, the idea that being 100% invested is going to make you the most money actually is a false idea. When I learned that, then it got me excited about diversifying, and even more so. Even though, what we tend to think is, well, diversification lowers risks, and that kind of seems like common sense. But in reality, it also can boost your long-term investment returns more than being 100% invested in something will do. The real trap that happens to people when they're 100% invested is eventually there's going to be a bear market, and whatever that thing is, and then you sell out. And that's, what leads to people selling on the bottom and, getting caught up in bear market crashes and ruined. And typically, though, what will happen is after someone experiences that, they sell out, and then they try to jump into something else and get 100% invested and repeat the same mistake over and over again. In reality, like the gold bull market here is interesting because this year we've had this huge run-up, but I can tell you that there's actually very few people in the United States that are even aware of it or even participating in it. And the reason I know is from my website. I don't get that many emails about it, even though I've been talking about it all year long. And there's lots and lots of people that sold out of gold and gold stocks last year or this January and really never got back in. So there is a lot of money on the sidelines out there that say, to use that phrase, that's there to get in gold at some point. So I think what's going to actually drive gold higher in the long run is a decline in the stock market that causes the people fully invested now to sell out on lows and bottoms and on a crash and get angry. And some fraction of those people will react to that by buying into gold and gold stocks. They'll see that they're going up and they'll try to get 100% invested in them. And that's what will drive the next second leg of the gold bull market and really make it begin to be more of a mass phenomenon than it is. Right now it's, just people like you and me and your audience that are in it that, have been following it for a very long time and are more knowledgeable. But we've got to get those less knowledgeable people into it to really create it into a mania and really drive it up to, let's say, gold 10,000 like Jim Richards talks about. That ain't happening until the masses get in it. Well, the masses will get in it as a result of, unfortunately, a realization that they've got to. If their bonds start to decline in value at the same time their stocks decline in value, you will start to see people pile into gold like you wouldn't believe. But, that's a process that doesn't happen overnight. You get a bear market, and in both and every month that it goes on, there'll be some people doing this, and it'll just build up and build up. So I think that's what the future is ahead of us in the gold market and, the stock market too.
Mike, thanks so much for chatting with us.
Thank you. It's great to talk with you as always.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.